Did you know that the average monthly rent for small businesses in America has increased 12% over the last 12 months? This is kind of crazy. And in this episode, I'm going to kind of dig through some of what I think is actually going on in the business environment. There's just a lot of conflicting data points right now. It's really hard in this day and age to make sense of what's really actually going on. Here's the silver lining in all of this. This is why real estate investing is crucial. Stay tuned as we break down these trends and show you how to navigate them to build the wealth that you want. You will not want to miss this. One of the simplest things, and I'm always trying to bring things back to, like, how does this matter to me as an individual? How does this affect my pocketbook? How does this matter to me as a business owner, an employer? Trying to really get to the point of like the macro discussion. There's all these things going on at an upper level that obviously we can't control, but I think that one of the things that I'm constantly trying to figure out is like, how does this really affect me and what can I do about it? Now, one of the good pieces of news and information is the recent report that came out on the jobs report. Unemployment is starting to tick up a little bit, which is a good thing. I don't know if most of us realize this, but our unemployment rate has been the lowest the last year that it's been since there was one other time in history that our unemployment was even this close. That creates some problems for us as business owners, challenges, if you will, because not only have we been battling inflation, which is beyond our control, but we're also battling inflation on the rising cost of wages. And because the job market is so strong, it's really challenging to grow a business when you're competing with so many other business owners to try to find top talent. And so what does that do? It increases wages. Now, one of the things as a real estate investor, I'm going to talk about a couple data points in this conversation about, what this means to us as real estate investors. But I kind of want to touch on the business aspect of this first, because I'm looking at this from two fronts. I'm a business owner, but I'm also heavily invested in real estate. So we own a mobile home park portfolio. We've got 50 employees across the country. Actually, that's ticking up at this point in time. But we've got these employees, we're running a business, but also we're heavily focused on real estate, obviously, not only in my personal portfolio, but our primary business is real estate investing. So even like I said, these data points that you're trying to constantly come back to, and how does this affect me? Well, real estate prices are skyrocketing, yet things are not transacting. Interest rates are high. It's really hard to buy more properties, but the values have not come down, and I don't think they're going to come down. And I'll talk about a couple reasons for that here in a second. The other side of this challenge is the jobs market. And again, I think from an unemployment standpoint, seeing unemployment actually tick up a little bit is one of the main reasons why Jerome Powell actually signaled this last week that we can probably finally see a rate cut. And I don't think it's going to be a huge rate cut. And one of the simple things, again, what can we as individuals look at? The Fed really has two mandates. Number one, control inflation, keep it under control. Number two, have a healthy job market. Now, when unemployment is too low, that is not actually a healthy job market, because it causes wage inflation that causes goods and services to just go up for each one of us. And the thing that I'm constantly looking at as an individual is, again, how does this affect me? And really, when wages go up, cost of goods go up. When inflation goes up, cost of goods go up. So this is the thing that the Fed has really been trying to control. And one of the big problems that I started this conversation with is rent inflation. I don't think that this is going to go away anytime soon. I actually think if there's one benchmark, conversation, data point, statement that I want to make, I don't actually think that we're going to go back to, prices the way that they were. There's all these videos floating around right now about how, groceries were so much cheaper, like 4 times cheaper a year ago than what they are today. Even though the Fed is signaling a rate cut, I don't think we're going back to any new normal. So I don't think that your rent as a business owner is going to decrease. I don't think that wages are going to see a huge plummet. I don't think that cost of goods sold are going to come way down. Even though we're seeing inflation coming down, what is this compared to? It's compared to a year ago, same period of time. When was the last time that you saw somebody raise the prices? Let's just say McDonald's. So they take a Big Mac from $1 to $2. When did you ever see a Big Mac come down in price? It doesn't. Very seldom will you ever see a price cut, because that's not how it works. And so all this price inflation that we've seen the last 2 or 3 years, I think in the back of our mind, we're constantly coming back to, when am I going to see prices come down? They're not coming down. And even though we're seeing inflation come down from a year ago, we're not going back to previous prices. So this is, I always kind of talk about this, but this is the new normal. And when it comes to interest rates, yeah, we're seeing interest rates come down, but I have one thing that I want to pose for us to think about. What do we think that interest rates are going to come back to? I was pulling up a chart before this, and I was looking at the inflation rate compared to the federal funds rate. And actually, when you look at the years after 2008, the federal funds rate went up to 5.25 after our inflation at that point in time was only 3.48%. We were technically in a crash at that point in time. But when you look at the data points on inflation, it actually bounced up and down, but it wasn't anything extreme. We actually went through a crash without inflation going through the roof, and it was obvious why, because we had just had this major shock to the financial system that most of us probably, didn't get our mind around. And as real estate investors, we're sitting back. I can't tell you how many times in the last, 10 years I've sat with people that are like, it's going to be 2008 again. It's going to be 2008 again. It's going to be 2008 again. I think we're in a different period of time. And when you look at this chart of 2008 compared to what we just went through in COVID, something really interesting happened. The inflation rate actually went up quite a bit more than it ever did in 2008. But if you look at the interest rate, the Fed's effective rate, at its highest, it was 5.33 in the last couple years. And when you go back to 2008, it went up to 5.26. I think the big difference of what's going on today versus what happened then is we had a major economic issue happen with the real estate market. And we had a major issue go on recently. It was COVID. But I actually think COVID allowed things to happen in the economy that needed to happen. Because so many people pre-COVID actually said, real estate prices are out of control. We can't keep this zero interest rate environment forever, or even low interest rate. I mean, even prior to 2020, looking at like April 2017, the Fed's effective rate was 0.9%. When you look at these two like competing, correlating issues here, I actually think we got to a point with COVID, whether it was manufactured or whether it just naturally happened. I'm not here to discuss that today, but I actually think that COVID allowed a few things that needed to happen in the market to happen. And I don't think we're going to go back anytime soon to a 0, 1%, 2% interest rate environment. I will 100% plant my flag on this unless we have some kind of major catastrophe happen in the market, like a 2008 or like a COVID again. And so assuming that nothing like that happens and we don't have some kind of black swan event, here's my kind of take on what's going to happen with interest rates. And then I'll bring this back to individuals and real estate investors. I actually think when you look at what's happening right now currently, we just had the Fed report come out and inflation's like, let's say it's at 3.25. There's really a couple things that I want to say about this. Number one, the Fed's mandate has always been to keep inflation around 2%. I actually think with all the zero interest rate environment that happened from, let's say, November of 2008, the federal funds effective rate went to 0.39 in November 2008. And it pretty much stayed below 1. I mean, it actually stayed below 0.5 until 2011. And then we started creeping up to just above 1%. It was 1.5 all the way to 2013. Then it went back below 1 and kind of stayed there. It was 0.12 in October of 2015. And then in 2016, it started ticking back up again. 2017, it gets above 1 again. 2018, it's above 2. It got up to 2.5 almost in 2019. And so then it dropped again completely because 2020 happened and we went all the way back down to 0. My point that I'm making here with all of this is that I don't think that we're going to go back to that, because I think the Fed has been trying to like stabilize all of this. And we went through 10 years, a little bit more than 10 years of almost 0 to less, sub 2% interest rate. So we had so many good years. The Fed's mandate is to keep it at 2%. And there was so many years where it wasn't even at that. And so borrowing was, just crazy. The economy was great. We needed that for a while to recover from 2008. And so even in the real estate world, we've heard this so many times, building wasn't happening at the pace that it needed to happen because of the shock from 2008. And I think as much as the Fed tried to, get the economy pumping, it was really challenging, not because they weren't doing a good job of, keeping interest rates low. They did do a good job of that, which spawned a bunch of, real estate investment, business investment. It spawned a whole bunch of research and development in businesses that I think kind of probably created the tech boom that we're seeing now because interest rates were so low. But the fact that those interest rates were so low for that long really should say that the economy should have done probably even better than it did because interest rates were so low. And so there's a competing thing that happens out there, and it's consumer sentiment, it's business owner sentiment, and it's real estate investor sentiment, it's builder sentiment. It's the idea that all of us that are out there investing in the market, investing in real estate, building homes, the consumer sentiment of outspending money. If you look at the interest rate environment being so low for as long as it was, I would argue that the economy should have done much better based on being able to borrow at, 2-3% interest rates. But it didn't do that great. And I think it was because of this mindset that we have as like real estate investors. We're still scared of 2008. We're still, looking back at the trauma that happened to us. And so I think bringing it to today, I think the thing that we're really up against, I don't think that we're going to go back to we're definitely not going back to a zero interest rate environment. I don't even think we're going to get back to 2%. We were at sub 2% for so long because sentiment was not great, even though the economy was doing pretty good. And then I think we got to this point when COVID hit, we all got scared, and then we came out of it like a fireball. And I think sentiment was actually really good and interest rates went back down. But I think we're experiencing a leveling at this point in time. And I've been saying this for a while. This is our new normal. And I think that we just have to make amends with the fact that interest rates are not going to be super low. Everything's probably going to be okay, barring some kind of black swan event. And we need to get used to these interest rates. So as a business owner, as a real estate investor, as an individual, what does that mean for us? I think at the end of the day, when you look at the federal funds rate versus the inflation rate, the Fed generally in a decent environment, which I think we're in right now, jobs are slowing down, which is going to mean that wages, it's going to be easier to hire people. It's going to be less expensive because of competition. We have these other challenges, like I pointed out at the beginning. I mean, the average business owner's rent has increased by 12%. I don't think that this means that our rent is going to come back down because real estate prices are not going to implode, barring a black swan event. And so that 12% increase, it's not like you're going to get 4% back next year because things are looking better. So this is the new normal. We need to get used to our costs right now. And yes, as business owners, we do need to be paying attention and cut costs wherever we can. However, we need to get kind of comfortable with where things are. So when they look at their overnight rate versus inflation, the Fed's fund rate, versus inflation, one of the things that has to happen, if inflation is 2% and we're in a decent economy, then we're not going to see 2% interest rates because that's not going to keep balancing the economy. And when you look at these ups and downs, the reason why the interest rate was so low for so long is because we were just seeing the economy kind of tick along. But after the inflation that happened I don't think this is because of COVID. Inflation was not because of COVID. It was because of 10 years of cheap monetary policy that just kept getting pumped into the system. And then COVID triggered this thing where everything kind of stopped, and it allowed, because supply chain demand was still high, there was a bunch of money in the system, and it disrupted supply chain issues, and it caused people to get a little bit concerned. It was the combination of all of that I think drove inflation through the roof. And so here's my prediction on interest rates in general. Unless we see something catastrophic happen, I actually think the interest rates have to stay up at the 4, maybe 5% interest rate environment for a while. Am I saying that we're not going to see a Fed rate cut? No, I think we are going to see that. But I think what they're going to do is give us a little reward and try to get in sentiment back up. And I don't think you're going to see 1 cut, 2 cuts, 3 cuts, and we're going to get back down to what everybody is hoping, that we're going to return to pricing. Rents are going to come back down. Real estate prices are going to come back down. None of that is going to happen. We're going to see a couple rate cuts, maybe 1, maybe 2. Everything's going to feel a lot better. People are going to start spending a little bit again, but not get out of control. And I've been saying this for a while. If they do too big of a rate cut, then buying, hiring, people wanting to buy real estate going to come back into the market. I talked about this on the King's Table episode, but for every 1% rate cut, it brings another 5 million real estate buyers into the industry. That is huge. So the idea that we're going to see a 1 or 2% rate cut over the next, year or two, go back to what we're all hoping and wanting, is just chaos. Because the minute that they cut rates too far, too fast, inflation just burns out of control again. So the bottom line with all of this is, if inflation is at 3%, which I believe is the new normal, I don't think we're going back to 2%. We might have some dips that go down to it at some point. But I think, even back to what I was saying about what Jerome Powell said, he said our new target is 3%. We're at 3.25% right now, roughly. And if you look at what a healthy market would bear with that, the interest rate has to be 1.5% to 2% higher than that. So if inflation's at 3%, then a stable market is going to want a 4 to 5% interest rate. So I think that's what we're really looking at in the future. And at the other side of this coin, it has been challenging for business owners. I think that's why Jerome Powell is finally saying we're going to see a rate cut, because if they don't bring it back, at least get sentiment back up for business owners, investors, et cetera, then he could have the opposite problem on his plate, which is taking us into a major recession. There's arguments that could say that we're, already in a recession, but into a major recession, if business owners, investors, banks, et cetera, don't put money back into the system, we could start seeing this go the other way. But contrary to what we would all want, I don't think we're going to see super low interest rates anytime soon for that reason. So at the end of the day, I think that what we really have to look at here is, what do we do with all of this? And I think the number one thing that we can do as individuals is, yes, look at our expenses. What we can do as business owners is control our expenses, figure out how we can get our income up, get better systems and processes in our business. But at the end of the day, I think the number one thing that I'm focused on, and what I think we should all be doing right now, is really just looking at, how do I adjust to kind of this new interest rate environment and not be hoping for that, 2%, 1% interest rate. Because honestly, if we get down to 2% interest rates, I think we have bigger issues in our economy that we're going to be wishing that we didn't have such low interest rates. I think the only way that we're going to get there is if we have a major big problem. So here's the silver lining in all of this. This is why real estate investing is crucial. Stay tuned as we break down these trends and show you how to navigate them to build the wealth that you want. You will not want to miss this.